It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can contact me at yourpersonalbank.com. Yes, you will reach me, yourpersonalbank.com. Funny how people still are surprised when they reach out to me, and I actually answer the phone or get back with them. So yes, you get to talk to me if you want to reach out and have any questions. Again, it's yourpersonalbank.com. I've been wanting to discuss some things about real estate for a while, and I've kind of held off on it because a lot of things are going on in that market. It's changing, much like the investment stock market, interest rates, bond markets have changed. If you missed last week's show, I discussed many of those changes. Last week, I discussed, due to the low interest rate environment, how much of the last decade the stock and real estate markets were really driving the bus. Now, with the higher interest rate environment, the high debt the federal government has, the bond market is really driving the bus, and that's changing everything. I kind of held off a little bit on the real estate news because it's more of a slow-moving market, and it takes longer for things to happen. But a lot has happened and a lot has changed. So let's hit on that because I think it's very valuable. It's very important. And I have a lot of people that ask me about this on a consistent basis. Many of my clients are real estate investors. So I saw this post here where people are confused. Houses aren't selling. Why aren't prices dropping? And there's a number of reasons behind this, but I thought some of the comments on this article were quite illuminating. As it points out, in a lot of places, home prices have doubled since COVID. And when you factor in the interest rates, you're looking at paying 3 times as much money in the long run, which is insane. And the question is, why is this happening? And if the houses are not selling, why are the prices not coming back to earth? Well, as they pointed out in this article and other comments, in many parts of the country are still hoping to cash in on the pandemic housing boom, even though their expectations are outdated. And another commenter pointed out that it seems like a lot of people are selling who bought in the last few years, so they paid a premium, and they're now just trying to break even, including closing costs. Another reason is many homeowners have mortgages that are under 4%, and they're reluctant to give that up for a new home with a 7% interest rate. As many commented on this post, we won't be able to sell for many years because our house hasn't appreciated at all and rates are higher now. So that's causing a number of people not to sell. And there's others that aren't necessarily desperate. And it's not that the greedy sellers are greedy or delusional. They just simply cannot afford to move. So they're prepared to stay in the home for a longer period of time. But I thought this other post was quite interesting where it states, smart ones will get out while they still can before everything tanks. And although there is a lot of pent-up demand in regards to buyers for real estate, a number of owners are sitting on large equity cushions or are renting their homes instead of selling. So price drops are going to be relatively slow and very uneven and will be very localized. Some markets and regions will be impacted far more than others. One of the real estate market experts stated the process will likely take several years and it'll become apparent suddenly rather than gradually. It is a fact that home affordability is at historically low levels. And quoting a recent study done by J.P. Morgan, a typical home buyer in 2024 had to spend about 45% more of their income on mortgage payments than they would have in 2019. And as the study pointed out, although wages did increase over the same 5-year period, they failed dramatically to keep pace with soaring home prices, the average being 50% increases and in some places even double. And although, as the study stated, affordability is not a new challenge for homebuyers, the data does show that the current challenge is more extreme than in the past. Now, interestingly, at the same time, we are now seeing the inventory of new single-family homes the highest since 2007 in certain markets like the South. Overall, as this study shows, Inventory has been the highest rates since November of 2007 for the past 7 months in a row. Now, what makes it somewhat difficult or challenging to follow, it's a very bifurcated market. If you just look at a chart for the entire country, things are a challenge but don't look horrendously bad. Prices are up, certainly. Inventory is now approaching levels, again, we haven't seen since 2007. But if you break it down into different regions of the country, if you look in the South and the West, particularly, you see significant increases inventory levels, where in other markets like the Midwest and the Northeast are still below pre-COVID levels in terms of inventory. So it's truly as the old saying goes about real estate, it truly is about location, location, location. So when I look at these charts that are showing overall inventory levels, pricing levels, etc., and they only are showing the entire country, there is definitely a leveling out because there is a significant difference in the different regions of the country. For example, one of the recent earnings call by Lennar, which is the second largest home builder in the country, pointed out the markets that were experiencing more challenging conditions in terms of pricing were Seattle and Portland, the Bay Area, Sacramento, Phoenix, Vegas, Colorado, and Raleigh, Atlanta, and Jacksonville. Those are the ones that they pointed out. But interestingly, even though many of the home builders are now offering record incentives and gross profit margins are down for the home builders, they still have a lot of room to go. In other words, during the pandemic boom, not only did prices of homes go up, but the home builders also jumped on the bandwagon in terms of their profit margins. For example, Lennar recently stated that incentive spending was about 13% of revenues, primarily due to mortgage rate buy downs to help reduce the cost of purchasing a new home. And although the gross profit margin for Lennar dropped to about 18%, and although their gross profit margins are down, they're coming off a period of when they were at some of their highest levels in history in the second quarter of 2022, where they were about 29.5%. So the profit margins for these home builders was at all near or at all-time highs during the pandemic boom of purchasing homes. So they have some room to come down and still be profitable. In a sense, the home builders, as I stated earlier, jumped on the bandwagon of the increased pricing of real estate, but ironically might be becoming part of the solution of helping real estate become more affordable, again, particularly in the South and the West. And the reason behind that is simple. They've been building more homes. Inventory has increased. It's basic supply and demand. As they continue to build more of these homes and more become available because the market is slow, the buyers are hesitant, reluctant to buy, or are just unable to qualify because of the higher interest rates and the higher costs. This is forcing the average sales price on new homes on a downward trend. This downward trend of medium single family homes sold peaked early 2023 and has been on a steady decline ever since. How far will this go is hard to predict. As been pointed out before, the cost of purchasing a home today versus 5 years ago has tripled when you take in additional costs of the home and the additional interest on the mortgage. So all predictions are showing that it's going to continue to be a meager housing market. Zillow and other analysts have predicted declining prices going forward, again, and particularly in the markets that have more inventory. This situation is not going to resolve itself anytime soon. In fact, regardless of what chart you look at from a historical standpoint, affordability is literally at historically all-time lows, and there's a lot of room to move and likely needs to move before becomes more affordable for the typical average household. Until that occurs, we're just not going to see a lot of movement in the real estate market. And it's almost like a game of chicken of who's going to win this game, the buyers or the sellers. And the reality is, I believe it's going to be the buyers more than the sellers because, again, right now, the typical household cannot afford the typical home. If they can't afford it, you can't get blood out of a turnip, can you? So the sellers can hold out, continue to hope for higher prices, but eventually more and more life situations will happen where for some reason financially the homeowner is going to have to sell that property, whether it may be a job move or another child or any number of factors that occur. We're starting to see more and more people moving because financially speaking they have to do so. I've got some more information on this I think you'll find very interesting with the real estate, so I'm going to encourage you to stay tuned. And then we'll also talk about some other things that are going on with the government debt. So I'm going to encourage you to stay tuned.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So interestingly, some of the latest numbers we've seen regarding the real estate market, Zillow, in fact, reported that 27 of 50 states has seasonally adjusted home price declines from March to April. This is significant because historically the spring selling season is the strongest period of the year for the real estate market. I've been discussing this for quite some time, but as I have stated before, the real estate market moves far slower than the stock markets or the financial markets for that matter. It takes time for people to realize that maybe their house price is not as strong as it used to be when they go to sell, or their neighbor sold it for this price a year or two ago. They're hoping to get the same thing. People are not on top of this as much as you might think. They're not paying that close of attention. They're living their lives. And those realizations occur, or they may then realize, hey, I can't sell it for what I'd like to, so I'll hang on for a while. But financial reasons, life situations occur that then cause or force people to have to sell. And as more and more of that demand to sell happens, the inventory continues to climb. Eventually, economic realities do take over. But again, don't expect it to be a super fast thing in real estate. It's a slow-moving process until it happens quick. The other big factor, of course, is the rate lock-in effect, where people had a really low interest rate mortgage, and if they do move and need a new mortgage, it's going to oftentimes be the interest on that new mortgage oftentimes will be more than double of what they were paying previously. And if we go back just even a few years, the number of people who had a really low interest rate mortgage was quite high percentage-wise. In fact, currently, we're still at more than half of homeowners that have a mortgage rate below 4%. That's declining as we go forward. In fact, just in the first quarter of 2022, for example, over 60% of Americans had a rate below 4%. That percentage is steadily declining because as people, again, are forced to move due to job changes, life situations, whatever that may be, as the days of those low interest rate mortgages become more distant, that lock-in effect will ease. Again, this is be a relatively long, slow process over the next several years, but it will dissipate over time. Even Lennar, in their earnings call, we could finally be seeing housing market deflation with new homes getting cheaper for homebuyers. You see, real estate typically doesn't go down. It's a rare occasion, that real estate values drop. We saw it in 08, 09 in the Great Recession, but that was an anomaly. I believe we're going to see it again. The primary reason is because the run up increase in values of homes was so significant that having a correction, much like in the stock market, a deflation or a reduction in the prices is a natural result. When things go up so fast, so strong, they tend to pull back some before they go back up again. I believe we're going to see some of that in the housing market. I'm not the only one saying that. Like I said, Lennar and other home builders are saying the same thing, depending on what part of the region of the country you're in. The other reason I believe that is we're starting to see another factor of where investors are starting to sell homes to cut their losses. It turns out that in 2024, investors accounted for almost 11% of home sellers, which is the highest share ever measured by Realtor.com. And to give you an idea of the difference, in 2020, investors purchased over 260,000 homes more than they sold that year across the country, where in 2024, 4 years later, they only purchased 100,000 more homes than they sold. So although investors are still buying more homes than they sold, it's at a much slower clip, 2.5 times slower than it was just 4 years ago. And investors typically purchase homes for two reasons. One, to capitalize on rising home values, or to make money renting them out. Recently, home prices have leveled off and are unlikely to go up in the relatively near future in most markets. Again, most analysts are predicting some kind of reduction in many markets, but rental prices have been falling for 21 consecutive months. So the profitability on real estate investment is not as strong as it was even just a couple of years ago. I'll use an example of a couple of clients I worked with recently in the short-term rental market. This was a phenomenon that became very popular in the past few years. And the idea behind it was you would rent a property, one that was suitable for short-term rentals, Airbnb, that type of thing. You as the investor would rent it long term. You would purchase furniture and et cetera to put into it and then rent it out short term, therefore earning the arbitrage between the cost you as the investor had of renting it long term and earning the higher returns typically for you get paid for short term rentals. Like Airbnb. This was a very popular strategy when the economy is strong. A lot of people are traveling, spending money. But I can tell you for a fact, a number of my clients who are investors that have done this type of thing, most are pulling back, if not getting out of that type of business altogether. The primary reason behind it is simple. The number of people that are renting short term from them has declined significantly over the past year or so. In fact, I was discussing this with one potential client who shared he had 9 of these type of properties. He was already planning to get rid of 2 of them because they were not profitable anymore, and he joked his best property, his house cleaner that he pays, makes more money profit per month than he does now on this. And his profits have dropped by upwards of 75%. Unless you have a location that is extremely desirable and stays rented out frequently with short-term rentals, this type of strategy is proving to be not as profitable as it was, again, even just a couple of years ago. Based on my years of experience, both personally and working with clients, he shared a bottom line number where he felt like it wasn't worth doing anymore. The time and effort investment was not beneficial. He'd already bypassed those numbers he had set where he felt like he would get out. He kind of justified it and was still involved to some degree, trying to hang on to see if things would get better. And as I pointed out to him, like I stated in the first segment last week's show, the economic situation has changed. Interest rates have changed. The economy has changed. Inflation has taken a hit, impact on a lot of people. Higher interest rates, higher cost of borrowing have also impacted many people's disposable income, the economic situation we're dealing with. The debt, the bond market are driving the bus instead of the stock and real estate markets now. Or as I pointed out to him, don't allow an emotional decision cloud your judgment on a strictly financial business decision. This is oftentimes where people get themselves in trouble. It's basic human nature. I've been guilty of this myself. It's hard to avoid. Sometimes talking to a third party or a mentor or somebody else who can see the forest from the trees can often clarify your thinking on that type of thing. And we discussed some of the numbers and the situation and what he was looking at doing. And when something like that no longer is profitable and is the situation is unlikely to change in the relatively near future, I know the decision can be hard because again, we want to hang on to something. Don't want to give it up, but sometimes you can't be blessed with something new if you're still hanging on to the old. God can't bless you with the new thing that he might have down the road for you if you're still hanging on to the old. And these are things you just have to consider and think about as an entrepreneur. As things change, as the economic situation changes under your feet, you have to evolve. You don't want to be a dinosaur and become extinct. You've got to evolve with the situation. These are the kinds of things I do when I work with clients and help them make better financial decisions or clarify their decisions, perhaps. Having your personal bank where you have funds available often help you in these transition situations. I shared some more things with this potential client just today that I think you're going to find very interesting. We had a very interesting conversation about lost opportunity cost, interest rates, different debts, loans, mortgages, and I was able to share with him when you should pay off a debt and when you shouldn't, particularly if you can incorporate your personal bank as a financial tool. I'm going to encourage you to stay tuned next segment because I'm going to share some of those ideas that he found very valuable.
Stay tuned for more common sense from Ferens. For more information, contact Ferens at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ferens Toth. Want more information? Contact Ferens at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferens Toth.
Welcome back to the Your Personal Bank Show. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So I was having this discussion, as I stated in the last segment, with this gentleman today. It was a really great discussion. He had a number of investment properties. We were discussing debt, interest, when to pay off debt, when not to, things like this. And a few questions that he asked really brought up some key financial literacy points that I share with people on a regular basis and are often misconception. I shared the example that I have used on the show recently. It's gotten a tremendous amount of response of the gentleman who had a $600 a month car payment. He was paying $1,200 a month to pay it off early. And as I stated to him, he could certainly continue to do that to pay off the debt. We understand why he's doing that, to get it paid off sooner. Or he could put the funds into your personal bank policy, earn dividends on the $1,200 a month in his example, borrow $600 a month from it, pay off the car debt, positive arbitrage, or keep the difference on the spread of how much he earned in dividends minus the interest he was charged when he accessed the money. So he's still earning some interest on money he spent, in other words, on the car payment each and every year the rest of his life. Has more money, bottom line, as he goes forward. And he understood that concept, which was great. One of the points I made is like when to pay off a loan or not. I get to ask this all the time. For example, if you're earning 6% tax-free, which, by the way, for most people, that'd be equivalent to about 8% taxable, because for most people, they're in about the 25% tax bracket, state and federal. It does vary, but that's the average American. And my point was quite simple. If your debt, the interest on your debt was higher than 6%, certainly you should borrow against the policy and pay it off. If your debt was lower than 6%, why would you pay it off early knowing you can make 6% insured, guaranteed, and tax-free? In other words, I run into a number of people, and I use this example, who have low interest rate mortgages that are still attempting to make extra payments to pay them off. Let's say they have a 3% mortgage, and they're making extra payments to pay it off, again, wanting to pay it off early. which I understand. I understand the motivation. But if you can earn 6%, insured, guaranteed, tax-free, highly liquid, why would you pay off a loan at 3% early? You're actually losing 3% on that money. It's called lost opportunity cost because you could have earned more than what the cost of the loan was. Now, I understand, again, you don't want to put it at risk because you could potentially lose it. But again, if it's insured, guaranteed, tax-free, you're insured to have that difference, that positive arbitrage, that spread, that difference. Again, he understood that concept. Then he brought up another question that I hear quite often is, well, what about on a mortgage? Because a mortgage is amortized, which means the interest is front loaded. For example, on a 30-year fixed mortgage, something like 85% of the payments for the first 7 years are all interest. You've not paid down that mortgage very much at all. You really don't pay down a 30-year fixed mortgage until really the second half of the mortgage. The first half is front loaded with interest. But again, I reminded him of the lost opportunity cost and compound interest. Compound interest benefits both positive and the negative. So it benefits you on investment, on growing, and it also punishes you on borrowing. If the borrowing rate is lower than what you're going to earn, you can still benefit from the positive arbitrage your personal bank can provide. Again, if you're earning 6% on the money and your borrowing rate is 3 or 4%, you can still pick up 2 or 3% positive arbitrage by putting the money in the policy, borrow against it, and make your mortgage payment. You will have more money in your pocket each year, every year, the rest of your life. Compound. Again, the compounding factor works in your favor also. So although in general I'm a fan of paying down or paying off debt, I'm also a fan of using what we call strategic debt. A great analogy is if you borrowed money to purchase a rental property and your income, your rents you received, exceeded your expenses, including the mortgage, can you build wealth that way? And the answer is we all know, of course you can, and we know and have heard of many people doing that. So it's not that debt is bad. Not all debt is bad. Consumer debt is bad, certainly, but strategic debt, you can build wealth. Again, if the cost of borrowing is less than what you're earning, you can build wealth. If you can earn more in rents than it costs you to borrow, get a mortgage and other expenses, you can create positive cash flow. That's how the entire real estate industry is built. What your personal bank does, teach us to people all the time, is you can earn positive arbitrage on your money that you spend for whatever reason. Imagine earning 1, 2, 3% on everything that comes into in your door, whether it be your household or your business. The gross. You borrow from the policy and pay the bills, the expenses, yet you get to keep 1 or 2 or 3%. The historical average is about 2% over the past 40 plus years. Imagine keeping a couple percent of everything you spend, your entire household or your business, every year the rest of your life. Would you have more money? The answer is, of course you would. You'd have significantly more money. That's the power of the personal bank concept. But let me get back to I thought that was some interesting thoughts he was sharing and questions that I get on a regular basis. I want to get back to a few last thoughts on the real estate market because so many things are going on there. As I stated, Lennar, the second largest home builder, is offering the biggest incentives they've offered since 2009. They're offering something like upwards of 13% on average of the typical home they're selling. Profits for incentives, mortgage buy downs, various things. Investors are now selling homes to cut their losses at some of the highest rates we've seen in quite some time. I think this is particularly important. The combination of the home builders continuing to build, offering incentives, which is going to put pressure on home prices on a downward trajectory. Even Lennar themselves state that. But let's use an example of Atlanta. As this article points out, only 3 companies control nearly 19,000 homes in metro Atlanta. And as they pointed out, this is a situation unlike anything we've ever seen in the U.S. This study was titled Horizontal Holdings, Untangling the Networks of Corporate Landlords by Georgia State University. Just three corporations own nearly 19,000 homes, single family residences in the region. This accounts for about 10% of all single family homes in these counties. Why is it so difficult to find is in this study by Georgia State University, these three corporate investors used an extensive network of over 190 corporate aliases. They were registered to 74 different addresses across 10 states, in essence, to hide what they were actually holding behind a veil of secrecy and insulate themselves from liability. You can understand why they're doing it, but it does have an impact on some of these markets where large corporations own a significant portion of the homes in a market. They have the power to influence rental prices. In some cases, it does shift neighborhoods from owner occupied to renter dominated, and these have impacts on these neighborhoods. Now, why I think this is so significant is if you put together the fact that a market like Metro Atlanta has about 10% of total single family held residences owned by large corporations, and many of these investors are selling their homes to cut losses because rental income has been declining for the past 21 months in a row. As some real estate experts have pointed out, this process of prices adjusting downward is likely going to happen slowly and then suddenly. In other words, there'll be a tipping point. If that tipping point occurs and these corporate owners decide they want to unload some of their inventory suddenly, this could have a significant impact on housing prices, in particularly in certain markets like Atlanta, for example. And from a more social or political standpoint, this is where I'm generally in favor of capitalism. You're not going to find someone who's probably more pro capitalism than myself. But at the same time, homeownership is a basic tenet of the American dream. And when an individual is competing with a corporation to purchase a home, oftentimes that large corporation with deep pockets is going to win out. Many times cash offers, things like that. I'm not in big favor of making homeownership more difficult. It's bad from society. So although again, I'm very much a free market capitalist, certain basic necessities I think should be in some degree off limits. Small landlords, I don't have a problem with because they provide rental properties for people who are unable or unwilling to own. I think they provide a service and a very valuable one. But I think large corporations, large corporate holders have significant impact that can be negative to many communities. And we've really never seen anything like this until the last few years where we see large corporations, Wall Street type firms getting involved in real estate. And I don't think it's a good thing. I think from a basic capitalist standpoint, I think there's certain things, as I stated earlier, that should be off limits. Some of those being the basic necessities. I would like to see more. I would like to see less of a profit margin in the food and pharmaceutical industries, for example, because we need to eat, and if somebody's sick, they need medicine. Housing is another one of those basic necessities of life. And it's not that I don't think companies with a profit motive should be banned. I hate it when the government takes a heavy hand on that type of thing, but perhaps they should have a different level of competition. In other words, it's already a position where, for example, if you're an investor, you have to pay a certain interest rate, usually 1% higher, but these large corporations typically don't use mortgages. They typically pay cash, so that they circumvent that restriction or that limitation. I think there should be some other things involved. Perhaps maybe they pay a higher property tax or something like, or maybe they pay the property tax and individual homeowners, primary residents, maybe they don't. I'm very much against property tax on your home. I've shared on this show many times where I'm very much not in favor of property tax for somebody who's paid for their home and they have to continue to pay the government for the privilege to live in that home. If they don't, they can take it from them. An investment property, I have far less of an issue with that. And I think that could be an area that could be considered where maybe investor owned property could pay property tax. Primary residents, particularly seniors, should be reduced or exempted from that. That could be one simple solution that could help address some of those problems and make it more competitive, would allow an individual or family to be more competitive against, say, a large corporate buyer when it comes to purchasing their home, for example. Stay tuned in the last segment. I got a few things about the debt and some news there that I think you're going to find extremely interesting.
Stay tuned for more common sense from Ferens. For more information, contact Ferens at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ferens Toth. Want more information? Contact Ferens at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferens Toth.
Welcome back to the Your Personal Bank Show. This is Ferens. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So our federal debt has just surpassed $37 trillion. The good news is it's starting to get a lot of people's attention, and they're recognizing that the interest on that debt is now one of the biggest threats our country is now facing. Interest payments alone are over $1 trillion annually. The federal government receives nearly $5 trillion of revenues annually. This is all sources of revenue. So this accounts for over 20% of total revenues received by the federal government are now paid out just interest payments alone. The more revenues that have to be paid on interest means less funding for other government services, including Social Security, Medicare, defense, infrastructure, you name it. But it'll also, as the debt continues to increase, the interest on that debt, it could crowd out private investment. It will drive up borrowing costs. We're already seeing that. And likely it'll stunt economic growth. In fact, the Congressional Budget Office estimates GDP could shrink by $340 billion in the next decade if the debt burden is not controlled. Their predictions are over 1 million jobs will be lost, and it would slow wage growth. See, the cost of borrowing will continue to stay high as long as the government continues to borrow and spend, because there's only so much money out there. And if the government is borrowing money, they're competing against you as a borrower, if you think about it. So if you want to get a mortgage or a car loan or something like that, if you're borrowing money, there's someone on the other side of that transaction providing the money. Typically, these are investors, often large institutional investors, who are providing that money that you're borrowing. Well, either they're going to loan it to you or they're going to loan it to the government. And if the government's offering a similar rate than you are, in most cases, they're going to be considered a better credit risk than you as an individual would be. And as the amount of debt that the government borrows continues to increase, basic supply and demand, that'll drive the prices of borrowing up, interest rates up. The ones providing the money will demand higher interest rates on their money as more and more of that becomes available, which will increase individual and business borrowing rates too. Because again, you're not going to borrow money at a cheaper rate than the federal government does. That's just highly unrealistic. The other part of it is, although we're not in a true crisis at the moment, did a deep dive on this, researching some of this information recently, and I heard a top economist discussing some of the fears about debt crisis, currency devaluation, all these types of things that people often become worried about. And one of the points that they made I thought was really fantastic is, the U.S. dollar, the U.S. economy was certainly the dominant economy for the past number of decades. And although, yes, we have more debt today than we've had at any time previous, percentage-wise, etc., we're still the strongest economy in the world by far. And it's not like our economic situation or a financial crisis will hit us to where suddenly our money will become like Venezuela, was an example he used. which has had if you look into that, has a disastrous financial situation and has a massive debt crisis. They're a mess. His point was, we may go from the most powerful, strongest economy in the world with the strongest currency and all that to maybe something slightly less valuable or dominant, maybe a little bit more like a Brazil, for example. And there's other stages. He used examples of other countries that were even worse off than Brazil, like Egypt. In other words, there are different stages of economic strength, currency, and all of this type of thing. We're not going to go from the best to the worst overnight. Shy of a nuclear exchange or a civil war, it's unlikely we're going to go from the best to the worst. There could be a gradual decline over a period of time. Decades, as he stated, would be the most likely scenario if we don't turn this bus around, if we don't change direction. In other words, we continue spending more than we receive, keep printing more and more money. Over time, yes, the economic situation will get weaker. Yes, we'll have more competitors. We'll be less dominant. But again, you're not going to go from the world's reserve currency to Venezuela in a year. It just isn't going to happen. And I like that point as he was making, because he wasn't, as he said, he wasn't discounting the significance of the debt problem that we're facing and the interest on the debt and those types of things. I've shared this quite a bit lately. Can we support it where we're at? Yes. If it continues to climb, is it unsustainable? If it continues to climb at the rates it is, absolutely. But again, this is something that's going to take 5, 10, 20 years even before we get to that crisis position where we would have some kind of economic upheaval. Does it mean we should just ignore it and not do anything about it? Of course not. Should our federal government stop spending more than it receives and start living within its means? Of course it should. That's just basic common sense. I often say this, only in Washington is common sense considered radical. There's no question they should live within their means and stop spending more than they receive. Should they start in fact, even beyond that, should they start spending down some of the debt that they've incurred over the last couple of decades, this $37 trillion that's out there? Of course they should. Would that strengthen the economic situation of our country? No doubt. Would it increase our currency and everything about where we're at, interest rates, inflation, and you name it? Would it help all those things? There's no argument. We should continue to push for those things and demand those things of our leaders, of our elected, they're really not leaders, they're our elected representatives. Should we demand those things? Absolutely. But are we in crisis mode? No, not yet. It's coming. I often say when I'm doing tax planning with somebody or retirement planning, I'll often say, do you want to be proactive or reactive? With tax planning, for example, if you do nothing, the IRS has a plan for you, right? And in most cases, their plan is far less favorable than the one that you could have pursued. It's just wise. It's just common sense. Until we can obtain some common sense in Washington, and the only way that's going to happen, again, is the majority of Americans are going to have to demand that from our elected representatives. But until that happens, as many economists and experts and investment gurus are saying, the trend of the U.S. outperformance in the U.S. stock market is over for real. They point out where, for example, over the past couple of years, that U.S. equities have been trading at about a 21-time PE ratio. That's price to earnings ratio, while the rest of the world has been about 15 times. Now, that higher spread or higher asset values has been justified by superior fundamentals of the S&P 500, and it was driven primarily by what many call the Magnificent Seven. This was caused by better earnings, better margins, higher payouts. But with a higher interest rate environment caused by the high level of federal debt, we're starting to see a markdown of U.S. earnings estimates. Many of the companies are reducing their earnings estimates. As this continues, the rate of growth in the equities will slow, if not reverse. And as like this other economist stated, a lot of people pay attention to the Fed, and for most of the past decade, Fed policy with the extremely low interest rates, easy monetary policy, that did drive the bus and why asset prices, equities, real estate did increase so substantially. But the debt is now the driver. The bond market is now the driver of the bus. It's an economic sea change, as I stated last week. It's a tsunami level type of sea change. In fact, the U.S. government budget as a percentage of GDP is negative 7% in 2025. Now, why this is so significant? This is the highest deficit level of spending that we've seen in the history of the country from our very foundings outside of any major war or severe crisis. To give you an idea, our government had similar budget deficits as percentage of GDP as the Civil War, about 7% at its worst. The oil shock of the 1970s was similar at about 7% budget deficit as percentage of GDP. The only times it was worse than that was COVID for a short period, World War I and World War II. As this chart points out, financial insanity is now becoming the new normal. Folks, that cannot continue. All of those situations quickly resolve themselves when the crisis or the war was over. We have to do the same thing here. We cannot allow our government to continue down the same path. It is unsustainable. In the meantime, what do? The government's lack of financial responsibility creates an opportunity. We're not going to go from the world's reserve currency and the most dominant economy in the world by far to total financial crisis overnight. This will be it'll be like a train wreck in slow motion. This will happen over a period of time. He even suggested perhaps even decades or more. You can take advantage of this opportunity over this time until they get their financial house in order, or we eventually do get into a crisis at some point down the road with higher interest rates. It's a golden era of fixed assets. You can take advantage of this. You can get returns unlike you have ever seen in over 40 years with annuities, dividend-paying insurance policies. This type of economic climate will tend to cause stock market prices to suffer and fixed assets to shine. Adjust with the economic situation. Don't be like the dinosaurs. Adapt. Don't die. Adapt. And you can then thrive. Contact me for more information at yourpersonalbank.com. As long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.